Welcome back. More than 70% of the S&P 500 companies that have reported their third quarter have already beaten Wall Street expectations on profits, setting the stage for the overall earnings growth story for the third quarter. We want to bring in Chris Ailman right now. He is the Chief Investment Officer of the California State Teachers Retirement System, also known as CalSTRS. Chris, good to see you.
Good to see you.
Thanks so much for joining us. So is it a fair statement to say earnings have been really driving market performance? What's your take on earnings?
Absolutely.
Yeah?
It's all about earnings. And you know, mixed bag of earnings again this quarter. But I think the bottom line is we survived October. I know we have a day left, but, you know, it is normally very volatile.
I'm giving you a hard time about that in the commercial break.
It's very volatile, and it's been flatlined, which is okay.
Yeah.
And as you said, it's going to be the employment number at the end of the week, and really it's going to be back to constant earnings growth, which is tough to see.
It's only 0.6%, right, in terms of the growth that we're expecting from the S&P 500. But it's growth.
It's positive.
Yeah.
And when you look around the world, we look at Europe, obviously with Brexit and with all of the European difficulties, we don't see much upside opportunity. Asia has consistently been a frustration. We thought that the Nikkei was going to rebound, but it's been slow. So, again, the U.S. is the best market out of the world, which is why I think we're still seeing some capital flows in.
Looking at your asset allocation, 55% to global equity and then fixed income, real estate, private equity, among those asset classes, where do you find the most overvalued assets or the toughest time finding something that isn't pricey?
Well, if you look at just a skew over history, you're going to see real estate, particularly markets like New York, but real estate, private equity, and global equity, particularly USA, actually at high valuation marks. Emerging markets are the most undervalued, but also it's not just one market, that's a whole basket of countries, and there are some unique opportunities, but it's really challenging. So people, you know, I always say we're feathering into emerging markets slowly. For us, that's just a constant, being a big ship, we don't spin on a dime, we just make subtle adjustments. We're going to increase our emerging market exposure. We're going to increase our non-U.S. exposure because we think eventually over time, and again, I think long term, as much as 10 to 20 years, that Europe and Asia will come around and be a stronger market. The U.S. really has had a wonderful bull market, doesn't die of old age, but we've run out of steam for over a year and a half.
We talk about the overvaluation of certain asset classes, but isn't that argument really muted in a low interest rate environment because the earnings power, and so that's why they're trading at higher multiples, because those earnings are worth more in a low interest rate environment? Yeah,
the low interest rate environment and negative interest rate environment in a good chunk of the world just makes everything very skewed. So returns are muted in this environment. Almost all the central banks are out of their tools, so it's very difficult for them to move and make any change to their economy. That makes volatility, and it compresses all the returns. So, I mean, we've seen barely a double-digit return out of private equity. Real estate's been gangbusters for the last 3 years, but even just low teens, not 20% returns like you would expect in a normal environment.
I have a quick question. I was in England 3 weeks ago on a conference with Warwick University in their economics department regarding Brexit. What do you make of the potential there regarding Brexit by the fact that I think there's been an exuberance exhibited by folks saying that the market would crash, and so far that hasn't happened. So what do you think is going to come out of the Brexit issue regarding markets and our relationship with the British on trade and that sort of thing?
There was a lot of hysteria.
Yeah, a lot. Still echoing.
Still echoing. It doesn't feel that way.
Yeah, my wife's here. She can tell you Brexit was a 3-day absolute headache. It was a migraine because, you know, with the volatility, and it was right at our fiscal year end, and then it disappeared. So we think long-term it actually will have a profound effect. It really is going to come down to that negotiation. The EU, you know, obviously there's another bunch of countries lining up behind it, so it's really up to how they negotiate with
so we just don't know what the outcome's going to be yet.
It's going to be slow and grinding, which is what everything out of Europe seems.
Does that factor your global allocation, though? Because you said you're getting into emerging markets. Are you taking away from the developed markets in Europe?
Well, the whole shift, we always had a U.S., a home country bias, and we're actually shifting away to that to more global. So we're going in, but yes, it's caused us to slow down our trades into Europe because of the worry about the currency.
Right.
We've really taken a step back with when it comes to London real estate, wondering what, you know, we know it's going to be strong. The financial markets are going to move to Frankfurt. But what is going to be the health and what's going to be the outcome? It's going to take 2 years probably to negotiate that once they trigger Article 50.
It just feels like the EU needs the UK more than the UK needs the EU at this moment in time because the economy is so weak there.
Absolutely.
But let me take you back to the US before you go, because you've got $191 billion assets under management at CalSTRS there. So when you look at sectors today, where do you think there is growth?
We thought that there's going to be continued strength in parts of the real estate market. We've liked private equity, but I have to say prices are at all-time highs. I think you are going to see some innovation opportunities, but venture capital, I would say, is tough for us. But obviously, in the next 5 years, we're going to see some extreme changes in that area. And then lastly, we think there's opportunity just in other strategies. We think people have to pay attention to their fixed income exposure. You know, if you don't know what duration means, you better study up on it, because the Federal Reserve has to raise interest rates, so I'm worried about fixed income allocations and where people are and where we are. We've been lowering our fixed income in the portfolio.
And not only if they unwind their over $4 trillion balance sheet of the fixed income instruments, that'll normalize rates higher. So as they sell those out in the market, rates will go up.
I've been pounding for normal interest rates for a long time, and you know, if you talk to John Williams of the San Francisco Fed, he said normal interest rates used to be 4, now they're maybe 3, 3.5. And so, you know, even to get back to what we think of normal rates, I would say are extremely low.
It's a long way from where we are right now.
It's a huge distance.
And those mark-to-market losses really impact investors and how they allocate going forward, too, even if they don't sell those fixed income securities.
Well, in fixed income, you're not going to have a 20% loss. They're going to raise, like you're saying, incredibly gradually. So, but just fixed income is not going to be a great investment opportunity. That said, I've been barking that out for over 2 years, and I've been wrong, because it has had tremendous returns. So it's just a matter of trying to figure out when to move in and out of those markets.
And I think the Fed starts raising in December?
I hope they would have raised back in June.
Yeah, I know.
I've been, you know, obviously they knew about Brexit, but now it didn't matter. But yes, I think absolutely they have to start, because as you said, if you move in a quarter point, even 3.5% is years from now at the pace we're going.
Funny. Chris, good to see you.
Great to see you.
Thank you so much. Chris Ailman there from CalSTRS. FBI